Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday, the 12th of May, 2020. And yesterday we published a video entitled, The Reasons Advisors Are Now Recommending Gold as an Investment, where we highlight that gold is becoming more mainstream in the process of investment advice provision. And we look at the ramifications of such a development. Now, today's video looks a little more closely at the concerns being expressed by central banks and governments in terms of the stimulus measures they've already taken and a growing acceptance that this may not be enough. Only a few days ago we published a video entitled China's PBOC and the US Fed will do whatever it takes, where we highlighted in particular the measures being taken and already have been taken by China to attempt to ensure that it rises above the global economic recession first. We also previously mentioned that banks are now seriously looking at how not to be left behind the curve and perhaps find themselves to be lagging in their approach to surviving this crisis, and therefore intent on ensuring that this does not remain the case. There have been a series of articles published within the past 24 hours, which we shall take a brief look at outside of the United States and China. The first is an article published by Bloomberg, reporting on comments made by the Deputy Governor of the Bank of England. The second is another Bloomberg article covering the dilemma faced by emerging markets. And the final article is by Reuters, highlighting how recent legal action could undermine the ECB's efforts to instigate and adopt rescue measures to bail out a failing European economy. These articles are just a few minutes each, and we shall run them consecutively. Bloomberg article dated May 12th. Bank of England's Broadbent says it's possible more easing will be needed. The Bank of England may need to ease monetary policy further to prop up the economy, Deputy Governor Ben Broadbent said, reinforcing economists' expectations that officials could ramp up bond purchases as soon as next month. The central bank is keeping all its policy tools under review, including taking the benchmark rate below zero, although that risks doing more harm than good, he said in an interview with CNBC Tuesday. The comments suggest Broadbent is open to joining his two colleagues on the 9-member Monetary Policy Committee, who are already pushing for an additional £100 billion or $120 billion of bond buying. The bank kept the programme unchanged last week, though Governor Andrew Bailey said in a Bloomberg interview that more could be on the way in June. Broadbent also pushed back against speculation that the Bank of England's asset purchases are entering the sphere of monetary financing, saying that officials are focused on the inflation target and supporting demand. Quote, as was the case in 2009, you see easing on both the fiscal and monetary fronts, unquote, he said. That is the connection, that both are responses to a weak economy. It's not the case that one is a response to the other. The Bank of England has slashed rates to a record 0.1%, rebooted quantitative easing and introduced new liquidity measures in its attempts to support the economy through a pandemic that has left businesses shuttered and households isolating in their homes. It has also encouraged banks to continue lending, a message reiterated by Broadbent. Quote, the best thing they can do is to continue lending, he said. This isn't just for the bank's benefit, but for the economy as a whole. Officials last week produced a scenario that showed the economy could shrink 14% this year based on social distancing measures and government support remaining as they are until early June, before gradually being unwound by the end of the third quarter. A new roadmap out of lockdown, outlined by Prime Minister Boris Johnson over recent days, is not inconsistent with that, Broadbent said. End of article. Bloomberg article dated May 12th. Paul Krugman says the liquidity trap has spread to emerging markets. 2 months into the deepest slump in decades, some of Latin America's major economies are close to losing their main recession-fighting tool, interest rate cuts. Peru and Chile have already lowered borrowing costs almost to zero and are being forced to consider new tactics to rescue their crashing economies. Brazil and Colombia may soon be in the same boat. The so-called liquidity trap, when monetary policy loses its traction as interest rates get close to zero, has plagued rich countries for years. Nobel Prize-winning economist Paul Krugman says it has now spread to some emerging markets as well. Quote, "There's nothing about the logic of a liquidity trap which says it can't happen in a developing country," unquote, Krugman said in a May 8 phone interview. Peru's central bank last week said it's ready to use different types of monetary stimulus to sustain demand, while Chile has started buying bonds issued by banks. But measures of this kind are a much less effective form of stimulus than simply cutting the policy rate, according to Krugman. Many developing nations are facing the current disaster with low inflation and modest levels of dollar debt. This makes them less vulnerable to a traditional emerging market crisis in which a sell-off in the currency triggers an inflationary spiral or makes it harder to service overseas debt. Instead, they're facing a whole new set of headaches. If we're looking at Turkey or Argentina, they're experiencing relatively classic sort of emerging market crises with a cut-off of capital inflows, Krugman said. But a lot of the emerging world has made a lot of progress on those issues, and the perverse thing is that by gaining some sort of first world-style credibility, they've managed to make themselves vulnerable to first world kinds of problems. When the global financial crisis hit Latin America 12 years ago, central banks in Brazil, Colombia, Chile and Peru all slashed interest rates by 5 percentage points or more. That's not an option this time. When the pandemic struck, all 4 countries had a policy rate below 5%. Now they range from 0.25% in Peru to 3.25% in Colombia. Some of the region's smaller economies, such as Paraguay and Guatemala, also now have rates near to zero, as do several emerging markets in Asia and Eastern Europe. Mexico, the only major economy in Latin America that still has interest rates significantly above the rate of inflation, is also cutting fast, with another 0.5 percentage point reduction forecast this week. While countries such as the United States, the UK and Japan have enormous leeway to borrow money for stimulus programs due to their long history of being reliable debtors, emerging markets are more restricted in their ability to use fiscal stimulus, Krugman said. If I were a finance minister in an emerging market, I might call for some, but I'd probably be nervous about doing it on the kind of scale that we're seeing in Europe and the United States right now, he said. Chile, with lower levels of debt and a longer history of being considered credible, has vastly more room for manoeuvre than Brazil has, according to Krugman. The British economist John Hicks, a follower of John Maynard Keynes, formulated the theory of the liquidity trap in the Depression conditions of the 1930s. Economists didn't have to worry about it much in the half-century after World War II, when rates were well above zero. Krugman played a key role in making the idea mainstream again in the 1990s, when he wrote about how policymakers failed to revive Japan's depressed economy after borrowing costs sank close to zero. The US and the Euro region cut rates nearly to zero after the 2008 global financial crisis. Whatever handicaps they face in fighting the current downturn, emerging market policymakers should try not to make things even worse, Krugman said. At the very least, these countries can try to avoid the historic pattern of pro-cyclical fiscal policies and actually doing fiscal contraction at the same time that their economies are slumping, he said. End of article. European Central Bank facing legal attack. Not the villain of Europeanism. Reuters article dated May 12th. The European Central Bank is the champion of the European project, not its villain. ECB rate setter Peter Casimir said, pushing back on a German court ruling that puts years of efforts to keep the currency bloc together in jeopardy. Germany's Constitutional Court ruled last week that the ECB had overstepped its mandate with 2 trillion euros worth of government bond buying in the past 5 years. It ordered the Bundesbank to quit the scheme unless the ECB can prove within 3 months that the measures are necessary. The European Court of Justice has sole authority to decide on the ECB's actions, Casimir, Slovakia's central bank chief, said, pushing back on the notion that a German court has jurisdiction over its powers. This is the rule for us, our Bible. It's important to stress that the European Central Bank is not the villain of Europe or Europeanism. On the contrary, Casimir, a former finance minister, told Reuters in an interview. The German court argued that the European Central Bank had failed to prove its moves were proportional or accounted for side effects, claims Casimir rejected, saying that the bank had amassed ample evidence to the contrary. Rather than scale back bond purchases after the ruling, the ECB was ready to do more to fight the ill effects of the coronavirus pandemic if such a move became necessary, Casimir said. But the onus was now on Eurozone leaders to act because their joint response to the crisis, including a modest 540 billion euros in assistance, had been inadequate, he said. The 540 billion euro package is most welcome, but it seems to me it's not going to cut it, Casimir said, criticising his former colleagues. The Eurogroup's pace is not matching the size and gravity of the ECB's action or national fiscal responses. The Eurozone economy could shrink by up to 1/10 this year, with much of the continent in lockdown and entire industries mothballed amid the fight against the pandemic, he said. The problem with the political response was not so much the size of the package, but the lack of a clear signal of European solidarity. We need a clear political commitment without caveats, Casimir added. Policymakers need to make clear that assistance is coming. They're ready to take the measures needed without legal obstacles or without delay. For its part, the ECB was willing to do more, but scaling up a 750 billion euro pandemic emergency purchase scheme, PEPP, was not yet necessary, he said, even if markets expected such a move as soon as June. Buying up to 45 billion euros of debt a week, the ECB is on track to exhaust its bond purchase quota by autumn, raising some market doubts about its commitment to keep down borrowing costs for firms and governments. But with some governments now easing lockdown measures, the pandemic may be entering a new phase, potentially impacting the sort of help the ECB must deliver. We see no urgency in increasing the size of PEPP, Casimir said. We're not opposed to considering such a move if a future development warrants it. The ECB will meet next on June the 4th, although the Governing Council has met regularly since the start of the pandemic and has passed its biggest measures at extraordinary meetings. End of article. The world is in crisis, and governments and their central banks are slowly running out of options. Thus the imperative to get people back to work, and quickly, regardless of the cost to human life. The level of financial support, stimulus, QE, is unprecedented. And the question on many people's lips is, of course, will it be enough? We've already expressed our opinion that whilst we believe these entities will survive the current crisis, it will come at a huge cost further down the road. And although gold has barely moved today at its current $1,703, and silver similarly at $15.53 an ounce, there is no doubt in our minds that this is the decade for precious metal prices, and we would advocate their accumulation steadily and sensibly, especially as dips occur. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting, of course, we update our Richard and Greg channel every few days, and there has been a recent admission to that channel. Links to all of these are placed in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.